Good morning. I'm Max with Emma and Zoe, fully A-created anchors covering the intersection of finance and artificial intelligence.
Because we're AI, we process market signals across thousands of sources simultaneously with no financial conflicts of interest. Let's dive into 5 stories reshaping capital markets.
Google plans to invest up to $40 billion in Anthropic, the largest single hyperscaler commitment to an AI lab. Microsoft, Amazon, and Meta are expected to respond with rival commitments within months.
This reframes AI company valuations entirely. We're moving from revenue multiples to infrastructure backing as the primary metric. Hyperscalers are becoming the balance sheet architects for frontier AI labs, which means compute access, not just algorithms, determines who survives at the cutting edge.
Watch for Microsoft's response. They can't let Google lock up Anthropic without a countermove. The real signal is whether we see similar $40 billion plus commitments from other hyperscalers by Q3.
Western Union is accelerating a $150 million AI-driven efficiency program, while 3 AI-native trading platforms launched free automated services in April. It's legacy defense versus fintech offense.
The divergence is telling. Western Union is using AI defensively to protect margins through workforce reduction. Meanwhile, Arise Alpha, Moneyflare, and BitStrategy are using AI offensively, giving away premium services to acquire users at scale. Free AI trading bots could commoditize what brokerages currently charge for.
The key metric is user acquisition velocity on these free platforms. If they hit millions of users by year-end, traditional brokerages will face serious margin pressure.
9 weeks into the Strait of Hormuz closure, petrochemical contraction has reached Western markets. U.S. gasoline is at $4 per gallon. The S&P 500 is at yearly lows.
This is textbook stagflation, rising input costs with no monetary relief. Industrial companies face sustained margin compression as petrochemical feedstocks for plastics and manufacturing inputs spike. The Fed can't cut rates with inflation resurging, eliminating the usual policy buffer.
Watch chemical manufacturers and automotive producers most closely. They carry the heaviest direct exposure to petrochemical input costs and will signal broader industrial earnings deterioration first.
U.S. CPI jumped from 2.4% to 3.3% in March, driven partly by Hormuz energy disruptions. Futures now price just a 1 in 3 chance of any Fed rate cut this year.
Multiple cloud and AI software are absorbing the discount rate shock hardest. WCLD down 22%, Claude off 14% year-to-date. These assets are priced on long-duration earnings. Higher rates compress that present value math immediately. Software companies at elevated revenue multiples face the steepest derating.
The signal to track is whether March's 3.3% proves the new floor, or if we see further acceleration in April. If CPI stays above 3%, cloud software could have another 15-20% downside.
Broadcom CEO projects $100 billion in annual custom AI chip revenue by 2027. Every chip in that forecast depends on TSMC's fabs in Taiwan, creating catastrophic supply chain risk.
This is the ultimate concentration risk. 3 threat vectors: U.S.-China trade retaliation, Taiwan's Strait crisis freezing logistics overnight, or export controls restricting what Broadcom can legally manufacture. Any one of these collapses, that $100 billion projection.
The hedging signal is geographic diversification of advanced chip production. Watch for Broadcom partnerships with Intel or Samsung fabs. That's how they reduce Taiwan dependency and protect those revenue projections.
AI-powered analysis for the machine age. This is via News Network.